Hey, everybody, it's Steve Olson. Welcome to the Investors Corner podcast. We have an awesome topic today, one that has been a long time coming. And it's been hard to get a great CPA on the show because they're just extremely busy with all these changes and the big beautiful bill and coming up against the tax deadlines. They're busy doing their job. And so my personal CPA, Ryan Lombardo, the tax nerd, is here with me today and has done a great job for me on my personal taxes, my K1s, and getting these returns done and saving me a bucket of money. And I always like having a great CPA who knows about reps, real estate professional status. I think it's the holy grail of tax savings. And we get asked about this a lot from our clients. So, welcome to the show, Ryan. Why don't you tell us a little bit about what you do as the tax nerd? And then we'll kind of get into the meat and potatoes of the interview.
Yeah, absolutely. Yeah, thanks, Steve. I appreciate you having me on. Essentially, from my background, I run a full service accounting and tax advising firm. So we work with like primarily entrepreneurs and a lot of like high earning executives or W-2 folks to basically handle like anything tax and accounting that they don't want on their plate. It's like we're there to help them out with it. And what I really enjoy about the business is like the accounting and the bookkeeping stuff. You kind of need that for like clean data in, good tax returns out sort of thing. But what I really enjoy is like long-term strategy and like wealth planning. It's like, okay, what are your investing goals? What are your wealth creation goals? And how are you making money now? And then what's the most like tax optimized way to get there? And it's like that long-term strategy work with clients is, a really enjoyable part of my practice. So when you reached out and said you wanted to talk about real estate professional status, I was stoked because real estate is magic for taxes, is what I always tell clients. So if they can get involved in it, then it's going to be massive for their finances.
Absolutely. Yeah, and shameless plug, like I said, Ryan is my personal CPA. We even amended some returns and he found some savings for me, refunds coming back, although the IRS takes their sweet time sending them. Ryan and I talked about that the other day. So, personal endorsement, he's done great for me. So you should definitely consider him, but I get nothing out of it, but I think it would help you as an investor if you're listening to this. So let's get into, Ryan, what we came to do. Um, Real estate professional status. What exactly is it? Why does it matter? Talk about that and passive versus active deductions and give us the 10,000 foot view if you would.
Yeah, absolutely. So there's certain like industries or, occupations that have, they have tax benefits. Like if you're a full-time like day trader, then it's like you can, deduct business expenses against what otherwise would be like capital gains or capital losses, things like that. But there's no occupational status that is as tax advantaged as real estate professional status. So essentially, as a real estate professional, there's, we can get into the tests and qualifying for all that stuff. But the big thing is when you purchase or acquire properties, there's generally significant depreciation deductions available when you acquire those properties. And those depreciation deductions would normally be considered like passive losses. And if you're not a real estate professional, those passive losses can only offset passive income. And so it can offset some of your rental income from the property because real estate is considered by default a passive activity in the eyes of the IRS, and maybe some other passive income that you have. But for the vast majority of my clients, they're still in working high earning age brackets, and so most of their income is going to be active income. So real estate professional status essentially allows you to take what would otherwise be passive losses that you really couldn't use in the current year. They just essentially stay on the books as an unallowed loss. It allows you to then offset that active income each year. So for my clients that either they or their spouse or both can qualify for real estate professional status, you can use these passive losses from depreciation and from properties to offset your active income and like significantly reduce your tax bill. And for high earners, you're looking at anywhere from 30 to 45% effective tax rates just on income taxes across state and federal. So everything we can do to, cut that down and get it to a lower percentage just keeps compounding, and it's just magic over time.
So, and I don't want to pull back the curtain on the qualifications and the testing for it. But as I understand it, tell me if I'm accurate here, Ryan. I've got a lot of clients who they're physicians, IT professionals, some kind of an entrepreneur, and they make a bunch of money, whether it's W-2 or through their S corporation. And there are tests you have to go through to say, yes, I am a real estate professional. But given that they're declaring on their tax return that I make money doing X, Y, or Z, they can't say they're a real estate professional because they've already said that this is how I make money. And so enter, for example, the spouse that maybe only works part-time or doesn't work, that can qualify as a real estate professional otherwise. And so now they can bring all of their active loss onto the return to offset, or dare I say, in some cases, eliminate the tax liability for the high income earner. Did I blaspheme in the tax world, or did I get it kind of right there?
No, that's absolutely spot on. And the best arrangement is really like the one that you pointed out, where yeah, you have like one spouse that is either, running a non-real estate related business and they're crushing it, or like you said, they're, high earning W-2. And if their spouse doesn't work, when I meet with new clients and onboard new clients in that situation, that is like the dream scenario, because essentially now that spouse is available to like, commit and like pass the test to qualify as a real estate professional. And once you do that, then yeah, they qualify. And all of a sudden, what would otherwise be passive losses from property investments can now, be considered like non-passive losses and offset, the spouse's other income source that is not real estate related. And there's some pitfalls or like misconceptions that we can get into there, but essentially, if you kind of have just a division of labor where like one spouse is trying to bring in as much money as possible, and then the other one is working on building up a real estate portfolio and meeting that qualification, then yeah, just like you said, you can either significantly, or it's honestly very common to fully eliminate federal income taxes with that setup.
Okay. Okay. And, that was unintentionally an excellent segue, but I gotta ask, and I'm not coming to either side of the debate here. As far as I understand it, when people get on TV and say Donald Trump is evading taxes, he's doing this, depreciation through active losses, is he not?
Yeah, yeah, he absolutely is. And I feel like the tax code is like the US Internal Revenue Code is just structured with very clear incentives. And so if you study like, from first principles, how is this thing created? It's incentivized real estate like acquisitions, and overall just like it gives you benefits for owning a small business or, running your own business. And yeah, so Donald Trump is a perfect example of that, where, has a ton of money coming in from all these different sources. And so long as, he's transacting and acquiring properties, yeah, you have these depreciation deductions that can offset it significantly. And so it's not evasion, even though it might seem like it to someone that's not familiar with the benefits of working in real estate. But yeah, they're substantial. And, Trump is a great example of that.
Yeah. Okay. Excellent. So yeah, that's our segue then. I mean, it's in my opinion the best way to minimize your tax liability that there is. So how do we qualify? What are the specific tests, whether it's one of our listeners or one of their spouses? How do we wrap our arms around this journey of becoming a real estate professional?
Absolutely. Yeah. So, I mean, there's a couple tests that anyone that's, given it a quick Google, like might be familiar with, but for assuming that someone's coming into this, totally cold, has never heard about reps or real estate professional status before. Two big things to keep in mind. Essentially, in order to qualify for real estate professional status, you have to perform, it's called like a 750-hour test. So throughout the course of a year, you have to perform more than 750 hours of service in a real property trade or business. And the second component of that is like the 50% test. So essentially, your real estate activities have to be more than, call it like 51%, right? So more than 50% of all personal services provided. Meaning, if you have a part-time W-2 job or a side hustle or a little business you're running, in order to qualify for real estate professional status, you just have to be putting more hours in on that than any other industry or trade. And that's, one of the pitfalls that we can get into. And I guess it's good to know up front, if you have a full-time W-2, it's basically impossible to qualify for real estate professional status if it's not, working in that industry. Because you would essentially have to make the case that you're working, 41 hours per week on real estate in addition to your core W-2. So that usually gets disallowed, which is why if you have a spouse that is not working or is working part-time, and you can, substantiate the 750 hours and that it's more than half of all the work they do, then you're in really good shape. And that 750 hours number might seem like, kind of like a big scary number, but over the course of a year, on average, that's 15 hours a week. And a lot of times with clients, when we evaluate, have they satisfied their hourly requirements and stuff, you have to keep in mind if you work on a project pretty, intensely, or you travel to a job site, or you travel to inspect a property, could very easily be working 10, 12, 14 hours per day on that if you're out there 100% for business and inspecting properties. So even though it might seem like a big number and kind of hard to qualify for it, over the course of a year, it's like most of my clients, if they're committed to being involved in real estate, have no problem hitting it.
Yeah. Yeah, 2 to 3 hours a day. Okay. Well, so that being said, what kind of activities are going to count? What kind of activities don't count?
Yeah, a very good question. So the big thing and what goes along with this test is what's called material participation. So under this definition, it's basically it's a two-part test where like you have to have the more than 50% of personal services provided, real property, trade, or business, and the hours plus material participation. There's a bunch of different ways to qualify for that. If you have the 750 hours, then you're going to hit the 500 hour, activity participation requirement for the material participation component. Um, but as far as activities that are allowed, people have to be careful. It's like, investor research or education usually gets disallowed. Coordinating with a property manager usually, is not going to be allowed and will be disqualified. So the big thing is material participation is just like, are you hands-on, actively managing the properties? Not necessarily like you have to be picking up, a wrench to go fix a leaky faucet or anything like that if you buy a rental property. But it's like, are you there, communicating with the tenant? Are you coordinating on the handyman to come out? Stuff like that. So basically just like hands-on. If you have a layer of management or you're outsourcing a lot of, the daily operation of the property, that's going to be harder. So activities that would count are, yeah, researching properties, meeting with mortgage brokers and essentially securing financing, negotiating the purchase, finding tenants, servicing the tenants like as the landlord and stuff to, make sure they're covered and good to go in the property. Looking at selling the property, all that stuff. So anything that you're actively involved in. And the good rule of thumb is like the more layers of management or outsourcing that you have in there, the further you're going to, further away you're going to be from qualifying for that material component.
Gotcha. I heard something that I wanted to make sure I understand. We've got 750 hours, and then you said 500. So is it a thing where 500 of the 750 need to be material participation, and the other 250 is much more flexible, or what am I missing there?
Yeah, so it's interesting. It's like the IRS almost has like overlapping qualifications here where, yeah, to essentially material participation, there's like, 7 different ways that you could qualify. So see, I have like a little list here. Yeah, so your participation was, substantially all of the participation in the activity by all individuals, or you participated for more than 100 hours and at least as much as any other individual. You materially participated in the activity for any 5 of the prior 10 tax years, whether that's consecutive or not. So there's all these different tests, and one of the tests is you participated in the activity for more than 500 hours. And if you already have the 750, it's not in addition to that, it's part of it. So
Yeah.
that's what
Yeah.
I mean by like kind of overlapping qualifications and stuff.
Yeah. Well, and an attractive thing for a lot of these people is having the property manager. They want their cake and to eat it too. So I mean, do you have clients where they do hire property managers and are still able to qualify? And if so, kind of what does that end up looking like? Or is that kind of a roll of the dice?
Yeah, you certainly can have property managers in there. Generally, if you're going to do that, then it's like, okay, you got to be fulfilling the hours like somewhere else. So it generally comes down to like, then you're probably going to be pretty actively, searching for new properties and, negotiating financing or negotiating like either buying or selling of it. So if you're going to outsource like the daily operations and you won't be able to claim the hours there, then you should plan on being like pretty active in terms of like finding other deals. And so for most of my clients, once they start hitting 6, 8 rental properties, then it's like, yeah, at that scale, you really do need a property manager for some or all of them. And then, they're not looking to slow down. It's like they're finding more properties and basically fulfilling the hours component that way.
What about like working with a general contractor? You've hired one, you found a site, you're building, you're dealing with architects and the GCs and all the insurance and getting this thing completed. I would assume that kind of activity counts.
Yeah, absolutely. Yeah, it does count. And, for the real property trades or businesses, I think it's worth, clarifying which industries qualify there. Because there's, some things that people might not know, and there's also some misconceptions. So, the most common industries are going to be like what you mentioned there. So, like if you're a developer or if you're a real estate broker, like you work at a brokerage, or you're, a realtor working for the brokerage, if you're a property manager, if you work in any sort of like construction relating to real estate, or if you work in like real estate investing or financing. So if you're in, one of those core industries, then you're going to qualify. And yeah, exactly like you said there, that sort of hands-on interaction with a GC to develop a site, that counts all day long.
Yeah. Okay, so I think you mentioned it briefly in there, but I want to clarify because this is a question that I get a lot. I know the answer, but I want the listeners to hear it from themselves, from somebody that is licensed to provide this kind of counsel. That what does getting your real estate license do for becoming a real estate professional, if anything?
Yeah. Yeah, that's the number one question I get was like it's either, oh, I have my real estate license, or I can reinstate it, all this stuff to qualify. And we always discuss this. Having your real estate license, it helps, right? If you need to document your case and like, basically substantiate the claim that you're making, but it's definitely not necessary. So for clients that are coming in, it's like, no, you don't have to go get your real estate license. You don't have to study for all that. It helps make the case and prove that you're committed to working in that industry, but it's definitely not necessary. And I'd say most of my clients are not, licensed realtors or contractors or anything like that. Their spouse is generally just involved in acquiring properties and managing them from there.
Okay. All right. So you become a real estate professional, you're loving the tax advantages, and you get the dreaded letter that the IRS is going to audit you. How do you document, how do you prove these hours to be able to clear that audit? What do people do there?
Yeah, that's a very good question. And that's the the second thing that people always ask is like, okay, do I have to get licensed? And then, all right, like how do I defend this? How do I make this claim?
Yeah, yeah.
So essentially, when you claim real estate professional status, that is just really reporting on your tax returns. There's no substantiation at the time. You don't have to upload documentation or anything like that. And the IRS audit letters, in my view, and in working with clients, those are only concerned if you can't substantiate it or if you didn't have good record keeping. So the way I work with people to get basically eliminate all the anxiety from getting that IRS letter is, and what sinks most people in an audit is just having really good documentation, right? So like what helps is, yeah, contemporaneous documentation. So like along the way throughout the year, you're, tracking your hours, you have meetings in your calendar. Like you're essentially building a time log with a little bit of detail on, the activities that you did, who you did it with, location, hours spent, all that stuff. You just want essentially a package for each year that if you're asked about it, or if your tax returns are audited, you can just present it. You'd be like, okay, look, I have this time log here. I have all these calendar invites. I have all these texts, phone calls, emails, where I'm interacting with people to substantiate the time that I'm recording. I have, a website, an LLC, whatever. It's just all these things you can point to basically say like, no, this is not just a paper, designation. It's like this is something that I'm really committed to and that I work in actively. And if you have all that stuff, and it might seem like a little bit of a headache to do it along the way, but if you take the time to do it, even on a monthly basis, then that way you're really not that concerned about it later. You feel good knowing that you're
Yeah.
making a good claim and it's easy to present it if needed.
Take 10 to 15 minutes once a month, go back through your calendar, create a log of what you did. You may be very happy that you took the time to do that later.
Exactly. Yeah, because if you get audited and you don't have that stuff, that the lack of documentation or record keeping is what sinks most people in an audit. Even if they actually had all those activities, if they can't prove it, the IRS is just not going to allow it. And the big thing there is even if you don't have the documentation, if you get audited and then you attempt to recreate it, it's like, A, you have to disclose that. If you don't disclose it, you're backdating it. That's illegal. That's a big no-no. But if you do recreate it, the IRS and the tax court essentially look at it and they generally just disallow it. You won't get in trouble, but you have to disclose that you're recreating your hours, and they basically don't believe you. Is what I've seen in from the tax court cases that have come out. And
Yeah.
yeah,
So what if this is interesting. So what if you've got like a Google Calendar, Microsoft Outlook that you can export and you show, hey, here's all my appointments. Here's what I was doing. Is that worth anything?
yeah, I would say so. I think that, yeah, recording everything in your calendar helps a lot here. Because yeah, you can export it, having, an email chains, contracts going back and forth, text messages with folks, phone calls. They're really just looking for proof of the hours that you're reporting. And, when you're recording the hours, you know, you don't you don't want to go, too far or like exaggerate anything, right? If you're traveling to a job site, it's like I wouldn't recommend logging, 20 hours of work there. The IRS doesn't always allow all the travel time. Like it varies depending on cases, but if you're flying out to, Texas for a week to check out a bill or check out a new development, I'd say if that's most of what you're doing throughout the day, you're in meetings and, reviewing stuff, 10, 12, 14 hours a day is like very defensible. But if you're going above 16, then it's like, okay, you're basically saying that like you slept for 8 hours, open your eyes, and we're straight back into real estate. It's a little bit of a stretch. But
Yeah.
yeah, the documentation you mentioned there helps a ton.
Okay. This is making me realize I've probably got like 2,000 hours. I wish I could lease some of those excess hours out to people. That'd be a great business. Um,
100%.
yeah. Okay. So I've heard people say before that you probably need a minimum amount of rental properties that you own too for this to be kind of a feasible strategy. Is there any truth to that, or is that bogus if you can prove, no, I've been looking for deals, I just haven't found any?
Yeah, it's a very good question, and it's interesting. Accountants are notorious for saying it depends, and so
Oh yeah.
unfortunately, I'm going to opt for an it depends here. So we basically have two components of it. We have like what the IRS audits and what they enforce, and then we have like what gets settled in tax court, which is kind of a separate thing because a lot of audits, if they result in back taxes owed, a lot of times taxpayers are not going to take that to tax court for the expense and risk of penalties and interest stacking up. But when it does go to tax court, uh, courts have essentially decided that the number of properties you have, it can contribute to your case, but it is certainly not the end all be all. There have been cases where someone with 8 or 10 rental properties had their real estate professional status disallowed, but another individual who had only one single family home qualified because he could substantiate, hey, look, I live up the street. I'm, driving down there on a weekly basis to mow the lawn, work on the pool. I'm fixing toilets, interacting with the tenant, doing all that stuff. And so he only has one property, but he hits the hours. And so generally when you have more properties, you're usually going to spend more time on them. So it helps you
Yeah.
meet the 750 hours, but it's certainly not, determinate. And you can qualify with just one, depending on how actively involved you are.
Okay. Talk to me about this really quick. I am the general partner on a couple of development deals. I spend a tremendous amount of time dealing with the accountants, the property managers, site visits, solving problems, reporting to investors. Um, Even though I've got a manager, there's a lot behind the scenes with managing this investment that's involved. I would imagine a general partner, no problem. But when you're a passive limited partner, that is passive. You don't spend any time. Limited partners are not going to be real estate professionals unless they become general partners in some other capacity or own their own properties. Yes?
Yeah, exactly. And that's the thing is being an LP in funds like yours is massive, but you essentially have to have the real estate professional status before you go into that because yeah, just writing a check and being an LP, even though you're sourcing great deals and it's going to be great for them personally, that alone is not going to help them qualify. But if they already have, their own properties or they're qualifying some other way for that rep status, and then they write you a check and they come in as an LP, then it's fair game. And those
Yeah.
otherwise passive losses become non-passive. So that is a big thing. It's like you really do have to get, at least one or two properties under your belt as an investor before you start writing checks as an LP and expecting to receive the benefits.
Gotcha. Gotcha. We didn't talk about this question. I'm going to ask, and you can hit the eject button if you want to. Have you ever had a real estate professional client get audited? And if so, what happened?
It hasn't happened from my clients directly because our documentation is always A, really good, and B, the returns are like well prepared and with, pretty like safe, defensible positions and stuff. I've had clients, hire me when they've been audited or they've, come on board in the midst of an audit. And so I've interacted with it. And yeah, the IRS agents are essentially there to, they're folks doing their job, right? You got to give them something that they can point to. It's like they usually expect their pound of flesh. Like they can't go back empty-handed to their boss, but so long as you have good documentation and you can articulate it, then yeah, those audits are usually only stressful because it's a headache to gather everything and like, schedule meetings and review all that stuff. But any claims that we're making, yeah, they're going to be above board, and so it's not that big of a deal.
So an IRS auditor is actually a real person that's semi-reasonable and is not like an alien.
It definitely depends on the one that you get, but in my experience, like some of them have a sense of humor, and even if they come up with an outcome that you don't like, I always think back to one where he assessed an audit for a client that had you know filed returns before they worked with me, and then I supported them during the audit. And he sent password protected files of his findings afterwards and called us with the password. And it said, IRS rocks 101. So it's just, they have a sense of humor. And even though it resulted in like a bill due for the client, it's like, yeah, they're folks doing their job. And
Yeah.
people make the mistake of being, in my experience, like too hostile with them and also making it difficult to give them what they need, right?
Yeah.
If you try to make the documentation tough to decipher, it's like the IRS agent they don't care. They're not going to put in the extra work to, try to see your side of it. So it's like you need to present a strong case just as clearly as possible for them to follow. And they're usually pretty reasonable from there.
Well, that's probably a whole different show on how to win friends and influence people. I mean, you're saying that treat them like people. It might help you a little bit.
Exactly. And sometimes I've had audits that I've supported where, it can result in a refund, right? You can
Yeah.
go in there and meet with the auditor and say, hey, look, we didn't claim all these things, but since we're here, like, let's include it now. And
Yeah.
it happens in sales tax audits, it happens in city tax and, state and federal income tax audits.
Wow.
So it's not always the end of the world. And many of those things either break even or sometimes, yeah, it's, much to the IRS's chagrin. It's like they're issuing a refund check for overpayment at the end of it.
That's funny. You got to be like, well, since you opened Pandora's box, here we go. Let's look at everything now.
Right.
Yeah.
I have all this other stuff that I didn't want to include because I didn't know if it qualified or if it was too aggressive, but let's include it now.
Since you're
Um,
here, yeah.
Yeah. And
Yeah.
yeah, and audits are really only a big deal if people are up to no good, if they're making
Hmm.
claims that they can't substantiate or they're fabricating income or expenses. And that's a whole different ball of wax. That's not what my clients and I are into. And so in that case, audits are, not the end of the
Yeah.
world.
Yeah. Okay. I got off tr topic there. It's kind of like IRS agents being real people. It's like when you saw as a kid and you saw one of your teachers at the grocery store or something during the summer. You're like, wait, they shop for groceries? They're real? Um, okay. So riddle me this. Somebody is like an IT professional. They're working a lot of hours, but not their entire life is at Intel or Facebook or wherever they're working. And they've got a real estate professional spouse. Could they conceivably combine hours to get to the 750, or does it have to be just the spouse?
Yeah, so on that one for the 750, it's just the spouse.
Okay.
Yeah, it's a good question. For the material participation, that's where it's interesting. Like spouses can combine hours for material participation, but not for the 750 hours or 50% of all personal services provided. So on that one, yeah, it is going to be all on the spouse.
Okay. Tell me why somebody thinking about real estate professional status should care about the big, beautiful bill.
Yeah, yeah. I mean, I think we're still deciphering some of like the changes in the impacts from that bill, but it basically, yeah, it was like the return of the holy grail for real estate investors because the main draw for real estate folks is that you can acquire properties and then take, accelerated depreciation on the property. So instead of, depreciating things over, 5, 15, 20, 27 and a half, 39 years, depending on the useful life of it. Now, all of a sudden, anything with a useful life of 20 years or less, you can take that depreciation up front. And for the last couple of years, it's been sunsetting. So it's been reducing by 20% per year. So 2022 was the last year where, you could write off 100% of bonus eligible property in the year that you acquired it and placed it in service. And then 23 was 80%, 24 was 60%. And this year was on track to go down by another 20% and then for it to fully phase out. Thankfully, with the one big beautiful bill, all that bonus depreciation is back. And that's basically going to make acquiring properties much more attractive for investors. They're going to get a lot more, I call it like a tax ROI, right? So like this much money I put into this property, I get this much back in depreciation and deductions to offset my income. So yeah, for once that bill passed, it was, that's incredible news for anyone that's interested in real estate.
Yeah, I like it. Okay, so I think you and I were talking about my return the other day about a townhome that I had purchased as a rental where doing a cost segregation was just kind of meh, but after the big beautiful bill, yeah, it's probably worth it for this single townhome. Didn't we discuss that?
Yeah, absolutely. Yeah, cost segregation studies are critical. Anytime people are acquiring real estate, and there's a few things to keep in mind about how to go about this stuff. There's certain types of properties, from what I've seen, that are more favorable for bonus depreciation, and it's a function of like region, right? So are you buying in a rural area where the land value is not very high, and so most of the purchase price is allocated to like physical depreciable assets versus are you in the city? So like the example I use is a, a, a half acre of land in Kansas is going to be a fraction of what a half acre of land is in Manhattan. And so if you're buying in a rural area, that's going to unlock a lot more bonus depreciation. And then there's certain property types that are more like beneficial. So condos, generally the least so, and then going up to townhouses, single family homes, multifamily, and then commercial industrial. And I think anyone that's been on social media for a little bit, you kind of saw that craze with, people buying like, storage lockers or gas stations or mobile home parks. It's like those asset classes are, very favorable to take a lot of bonus depreciation up front.
Yeah. Yeah, interesting. So I had a question from a client this morning, and we're almost done here. I've been really interrogating you, and I appreciate your time. Um, but we were talking about a fourplex in the Midwest, and the client was asking me, what percentage do you think can be allocated to land versus, vertical improvements, the actual stuff you can depreciate? Because I've long said, yeah, you're going to get a lot more bang for your buck in the Midwest than in California, where 80% of what you're buying in California is the dirt versus
Mhm.
that's different in Indiana or Tennessee or Alabama, for example. So is there a set formula that you would use, or is that on a case by case basis to determine what percentage of this basis is land versus improvements?
Yeah, so a lot of times I will advise clients with like, if we're just like evaluating a deal, it's kind of back of the napkin math to figure out like, okay, this region, we can assume like this much is going to go to land. If you want to go in depth, yeah, the cost seg study will handle that for you. And a lot of times you can also look at like county property tax data. So they're going to have their assessments of the property showing like in their view what they view the land and what they view the improvements are worth. And so if you want, a source from the county, that's a really good one to go to. Trying to think for the Midwest, I would say, yeah, if the land value is above 25% of the purchase price, that's probably going to be pretty high. I generally see like 15 to 25%, depending on the metro it's in for the Midwest. And
Okay.
uh, while that is a component, what I usually look at is basically like as a percentage of the purchase price, like what can I expect for bonus depreciation here? So
Yeah,
for
yeah.
a fourplex in the Midwest, that if I was to just guess it offhand, I would say 25 to 35%. So I call it roughly 30% of the purchase price you can write off in
Hmm.
year one. And that, of course, is a very general estimate. But if you look at deals that way of like, okay, I'm going to buy this place for $1 million, I get $300,000 back in depreciation when I buy it, that can really inform deals and what you decide to invest in.
But it sounds like if you ran that math, you may ultimately try to look at the assessment from the county assessor, and that would tell the ultimate tale.
Right. Yeah, it's certainly
Yeah.
it's a very good source of info, and I see a lot of variations. Like they will generally understate improvement values, and so properties will sell for much more than like what the county had it pegged at. So when I work with folks that do cost segs, I usually leave it up to the professionals to figure out those allocations, but the county land is a pretty good starting point.
Yeah. And probably a very defensible starting point in the event of an audit. When you can show a statement from, Davidson County or whatever, that's going to be tough for the IRS to argue with, I would imagine.
100%,
Yeah.
100%.
Well, hey, um, it's tax season and you've got a lot going on. Before we wrap it up, which we will do so soon, are there common pitfalls, other common questions, or anything that you would advise people on as they consider this?
Yeah, I mean, the one thing that's been in the back of my head, and I'm glad you brought it up, is make sure that if you're working with someone to prepare your returns on this stuff, it's like the documentation, which we already went over in depth. But the other thing, and like a lot of people don't know this, especially if they're new to real estate, is it's very important on your taxes to essentially make an election under Section 469 to treat all rental real estate activities as a single activity. That can really foul people up in an audit. Because essentially, what that does is it says, hey, look, I have, one or three or 15 different rental real estate properties, and I'm going to treat my qualifying hours and my material participation for all these properties as a batch, as a single activity. If you don't do that, then essentially the IRS is going to say, okay, each of these things is a separate activity. So show me your material participation for each of your rental properties. And
Oh.
people generally can't do that. So yeah, it's very easy to do on your taxes, but yeah, essentially it's a Section 469 election to group all of them as a single activity is huge. Um, yeah, other little things, there's de minimis expense elections. So if you have like small improvements that you're making to the property, rather than having to capitalize those and depreciate them over time, it's like you can opt to expense those if they're under certain amounts, all those things. But yeah, I'd say just, going slow with your tax returns, making sure there's good documentation. And I guess a final point, if you have rental real estate that you acquired in prior years, any tax professional worth their salt will know this. But these are some of my favorite clients to work with. if that bonus depreciation, let's say there was bonus depreciation available on a property, if it wasn't claimed in a prior year, but it should have been, because technically you're required to do bonus depreciation, you're supposed to opt out of it. So if you didn't bonus depreciate eligible properties, you can actually go back via, it's called Form 3115. So change in accounting method. And you essentially go back, you change from an impermissible depreciation method to a permissible depreciation method. That allows you to claim the bonus depreciation from prior years on the current year's tax return without having to amend all the other returns.
Oh,
Um,
that's great.
yeah, and that's huge. So for people that come in, if they have a big income year, and I already had this season with a couple of clients in Utah, they come in, they had a big income year, they had a rental real estate that they didn't claim bonus depreciation on. There's hundreds of thousands, if not millions of dollars in deductions that can be claimed with a 3115. And if your spouse qualifies for reps, then perfect. You're off to the
Yeah.
races. So I would say those are the things to be wary of, and just know that like there are likely benefits available to capture from prior years that should at least be explored.
That's great. Thank you so much, Ryan, and everybody. If we certainly hope you'll consider this and talk to your CPA about it. If you don't think that they're the one, or you're looking for somebody like Ryan, just reach out to us and we're happy to put you in touch. He's been great for me, but I think regardless of that, it's been highly educational, very helpful. Ryan, we thank you for your time and being on the Investors Corner podcast.
Yeah, absolutely. Thank you very much for having me, and great questions. I think audience will get a lot out of this one. So appreciate the time.
Yeah, good luck wrapping up the tax year.
That's right. That's right.
All
Thank you,
right.
sir.
Thanks.